afternoon, everyone. Thank you so much for having us today. The topic is wealth management evolution, the next frontier for alternatives. So I think for most of us following the news or looking at CNBC, a focus is that's been promoted not only by sponsor side, but wealth managers is that, the 60-40 model isn't enough. There needs to be allocations to alternatives, and you can't go a day without seeing the democratization of alternatives in the newspaper. So we're going to talk through some wealth management issues with two experts here. We've got Jasmine Yu from Bryn Mawr Capital Management and Nancy Donohue from Summit Rock Advisors. I think first off, since their businesses are a little bit different, we're just gonna, give a little bit of background on their organizations and who their clients are. So I guess, Jasmine, if you could give us some background on Bryn Mawr, that'd be great.
Great, thank you, Dennis. I'm Jasmine Yu, the Chief Investment Officer for Bryn Mawr Capital Management. We are a bank-owned RIA, Registered Investment Advisor. The bank is based in Delaware. It's a regional bank. And the RIA is based in Philadelphia. We have teams in 7 different locations, including me, based in New York, on both coasts of the country. 80% of our book are primarily in high net worth, ultra high net worth, family offices, and we also have a book of business in endowments, foundations, and retirement businesses.
Great, that's super interesting. And I know Summit Rock's a little bit different, Nancy, so
Yeah.
I'd love to hear about your client base and what you guys do.
Thanks, Dennis. Jasmine, too. Good to see everyone. Summit Rock Advisors, I'm the co-founder, chief investment strategist. We look after $23 billion of assets. We have just 49 clients. You can think about our business as 35 families and 14 standalone charitable organizations. We become the central investment office and finance office for our clients' wealth. All of our clients are based in the United States. A few unique things about us. We have full wallet share, so we're looking at the entire financial system for our client base. We also pair low-fee, liquid, index-oriented investments with active managers. So we're on both sides of the passive-active investment arena.
That's great, that's great. So, kind of cutting down into what maybe people in this room are focused on at the moment, or what asset classes are you guys targeting as a firm, or your clients interested in? Maybe what asset classes are you not as bullish on right now?
Yeah, I'll start. So we got roughly 4,000 client accounts within the RIA, within the bank. The way we manage, we're really goals-based, where we will divide client objectives along the spectrum of income and growth. And we have 6 investment objectives sliding across both income and growth. We do annual capital markets assumptions, and we also set our strategic asset allocation, which is to look out for the next 3 to 5 years, and the capital markets assumption is good for the next 10 years. But it's an annual exercise. Most of our strategic asset allocation, as well as our policy goals-based portfolios, we have alternative investments across both liquid alts in the 40 Act format, private hedge funds, private equity, private credit as well. Now, on a tactical basis, which is really a view for the next 12 to 18 months, we will move our asset allocation around beyond our traditional strategic asset allocation. So when we look back, in October of 2024, we were already a little uneasy about US equities. That's where majority of our clients allocate. At that time, we certainly did not foresee global tariff, global trade war, tax legislation, or Doge, government spending cut, all of these things coming. We did not see that, but we were uneasy because of the very high valuations in US equity. So we advocated a defensive approach, and before Liberation Day came in April, we actually moved our portfolios to be more defensive, meaning, we wanted to run closer to our strategic asset allocation, including the reallocation to international developed equity, reduce high yield bonds, reduce emerging markets debt, as well as topping up our allocation to hedge funds, and particularly those that can provide little or no correlation to traditional equities and fixed income. Now, our view on private strategies, private equity, and private credit has been a little bearish for some time. We're thinking, interest rates continue to be very high. If you look at the Fed funds rate, it's at 4.25%. And the Fed is in, a difficult position, both to cut and not cut, and probably will not move, for the remainder of Jerome Powell's tenure. And given that view, we think, the deal activities in the private space will continue to temper down. And in fact, we have already seen fundraising in the first quarter for private equity came down by 35% compared to the same period in 2024. So we continue to be defensive. We like liquidity, we like income generation, and for the time being, we have also rotated a bit more to non-US, both across developed equity, developed fixed income, as well as European credit and managers that have a tilt towards Europe.
Yeah, no, super interesting. I saw today, I think Torsten Slok, the economist, was saying the private equity deal levels are the slowest they've been in a few decades, and didn't see them picking up. So very interesting. Now, Nancy, on your end, similar or?
I'll weigh in on some of the themes that our team is working on right now, and what's been helpful and what hasn't over the past period of time. Because we pair low fee liquid index strategies with active managers, we think this is one of the best times to be building and showcasing our hedge fund program with our client base. We work with about 25 different hedge funds, and we have a scorecard internally for how we measure our hedge funds. With interest rates being very volatile, we're getting a nice return premium over interest rates in our hedge fund program. We look for our managers to be able to generate statistical alpha. We look for them to provide downside protection in a market drawdown, and we've had a few real life stress tests as of late. And we look to, of course, assemble a group of managers that can perform above the peer group. But this is one of the best times in a long time, we think, to be showcasing our hedge fund program after equities performed so powerfully over the past 2 calendar years. Inside of our hedge fund program, we take a big tent approach. Something that's been very useful for us in the past period of time has been blending fundamental strategies with quantitative strategies. In the quantitative arena, we work with managers that are systematic, managers that use machine learning techniques, and we have found the alpha streams from the quantitative strategies to be very diversifying from the alpha streams that come from fundamental strategies. And the quantitative strategies tend to turn over more quickly, so we're getting a little bit of time diversification too, letting the fundamental managers have, in some ways, a longer time horizon to realize their alpha potential, and we're putting more of a burden for the near-term alpha manufacture on the systematic managers. So that's something that's been very useful to us. We don't want to accomplish everything with managers, given sort of like a fee and liquidity budget that we think about for our client base. We were fortunate enough to add a position in gold through ETF format to our client base like 2 or 3 years ago. We did it to have a hedge against inflation, a hedge against recession, a diversifier versus equities. All of these things have come true and more for us. So now as gold is at these newer, higher levels, that last panel was great in terms of thinking about some of the new territory that we're in with gold, but that has been a wonderful diversifier in a low-fee liquid, like one-touch format. We talk about the gold position as an asset allocation tool. So if we do see a recession and interest rates and perhaps gold rally and equities decline, we have an ETF position to very quickly pivot into the equity market. We don't have to wait for manager lockups to like unwind to shift and move our portfolio. So again, like the liquid side of the house is working hand in glove with active managers to produce a total whole like output for our clients.
And seeing that we've seen on the news, I think some experts suggesting that the allocation to maybe crypto shouldn't be zero anymore. Are you seeing any client demand for kind of crypto and crypto opportunities?
Yeah, interestingly, you asked that question. So in March this year, we published a white paper for our clients on the subject of digital assets investments. We do see the pickup in client demand, particularly in Bitcoin. So we have approved a Bitcoin ETF for client access. But the way we think about getting exposure to the space is beyond just Bitcoin or just the long-only equity market. So we told clients there are several ways to gain exposure. If you're not easy about Bitcoin, you're not easy about alternative investments, maybe you can go with a public equity ETF, which is focusing on the blockchain technology. So looking at it from a technology standpoint. For those clients who can really invest in hedge funds, private equity, we are working on a hedge fund that's really doing the arbitrage between public markets and less liquid markets, you know, arbitraging between the United States versus Japan, say for example, for the coins. And then we're also working on venture capital funds, which is pretty big in the space.
Crypto is called digital gold. We've done a lot of research on it. It's not gold, it's very pro-cyclical, so it's not as diversifying as gold. We do hold a few dedicated manager positions in the venture space. That has been quite beneficial for us. Also with the more friendly regulatory regime, we're beginning to also study perhaps holding like ETFs. The ETF crypto access has really evolved like quite a lot. It is high volatility, so it could bear well for long-short strategies. We've researched them, we haven't added them, but anything that has a quotient of high volatility measured with expertise, I think could be ready for a long-short format, and it's in our research queue right now.
Yeah. No, and it's interesting when you hear about your client base and you hear charitable foundations, high net worths, family offices. It really seems, you know, trust between you and your clients. Like these are very personal relationships. As folks are expanding into the alternative investment world and kind of getting access to managers, what are you guys focused on when trying to choose a manager, start a relationship, you know, big, medium, small? I assume it's just not fees and returns, though that's probably a ton of it. But would love to understand what you guys look for in a manager and a partner.
Sure. Fees have never been an issue for us. We always believe in pay for performance. Whereas we do emphasize on several other things. For example, key people involvement. We've seen some firms out there, they may have the founder's name on the door, but the founder is no longer involved. We like team-based approach, especially, you know, teams that has longevity and stability. We like firms that put a lot of emphasis on risk management, and not just risk managing their investment strategy, but also thinking risk management of their own internal operations, how they run their business. Most of the smaller managers, they don't fail because of investment due diligence, but they fail on operational due diligence. We also emphasize a lot on implementation because oftentimes good ideas, if they're not being implemented, then they don't count. So we like managers that who are not just good thinkers, good communicators, but they can actually also execute.
Fees are somewhat of an issue. We look to have an overall fee and liquidity budget for our clients. When we're paying manager fees in the hedge fund space, we do expect statistical alpha generation and downside protection in an equity down market. And we're generally getting that, and we're really pleased to pay the fees to get that outcome. In the equity space, we have like vanilla chocolate strawberry, low fee passive, active public, and then private, and we have return hurdles for each of them. We will admit that active public equity management has been challenging in the past period of time. So one of the things we've worked with our managers on is, can they make more efficient use of our capital? Can they give us an equity beta index and then take some of the excess capital and put it on top in a portable alpha or alpha extension strategy for us, so that we know we're like adhering to the index, but the manager is making more efficient use of our capital. And that's been a great way to engage with managers, and I encourage managers who have an alpha engine to think about how they're going to package it in service of their clients.
That's great. Now, like sticking to this theme of trust and this being all a little bit of a new world, I know you've got different organizations, thousands, less than 75 clients. In our world, it's getting complicated. Interval funds, tender offer funds, BDCs, 3C7 funds, opcos. There's a lot to learn. Even for a lawyer who's been doing it for 20 years, all of these things to learn and the concepts. Mm-hmm. What are you guys doing to kind of help educate your clients so they understand the liquidity, semi-liquid, evergreen, drawdown funds, just to kind of make them kind of appreciate that this is a different style of investment? Mm-hmm. I don't know, Nancy, if you want to kick off this one.
Sure. One of the fun things about working with families and charitable organizations, mission-driven, these folks are very informed about what's happening in the world and in society. So it's on us in an education format through our in-person meetings. We just have 50 clients, so we're meeting with each client in person, 4 times a year. But we have to be able to articulate, Jasmine, I'm sure like you, what's happening with policy, what's happening with the economy, what's going on in financial markets, what does it mean for me? So this education format that we have through our written content, our charts, our in-person communications has become like a very big part of our enterprise. We also developed what we call a year in the life of a client. Like this quarter, every client is getting their year-end private equity review. We're giving manager case studies about what's like working in private equity and where we're having some challenges. And we're right-sizing our allocations for the next 2-year period of time. So these are like deep dive education modules that talk about the manager set itself, our approach to portfolio construction, the backdrop and ecosystem for investing. And we say at our firm, like there are 2 CIO activities. One of them is like diving in and making the investment program as strong and powerful and continuously improving all the time. The other side of the CIO coin is like getting the good word out about what's happening in the program to inspire like our client confidence. This is especially important in the private equity and the venture space. In our firm, we say that those allocations are the biggest use of the trust budget, because you have to get the client thinking about like a long-term time horizon. The private equity valuations and returns and distributions move very differently than your public equity space. Mm-hmm. So this is the biggest use of the trust budget in our own discussions with our clients. And education is so key to inspire their confidence in who we are and what we're doing, so that we in turn can have the flexibility to work with the managers like over a long period of time.
Sure. Yeah, for what we do, we start out with our investment philosophy. So first and foremost, we run goals-based portfolios, as I said before. And we manage investments to meet clients' long-term goals. And our ways of getting there include diversification. So we run globally diversified portfolios across multiple asset classes, long-only equities, fixed income, alternative investments, inclusive of hedge fund, private equity, private credit as well. And we also believe in flexibility. What we mean there is really the use of both active, passive managers. We're also vehicle agnostic. We can be in daily liquid 40 Act hedge funds, and we can also be in monthly subscription, quarterly liquidity hedge funds, evergreen funds, interval funds, or longer term lockup vehicles. So flexibility is the key. And I also mentioned the time horizon, right? We're long-term focused and short-term aware. We do our strategic asset allocation, which sets the view for the long term, but we also do tactical asset allocation, and that's more short-term aware. And we pull all of these levers, diversification, time horizon, flexibility in portfolio construction, in the selection of vehicles, in order to get our clients to meet their long-term investment objectives.
That's great. That's fascinating. So, as the options for folks to invest, it's kind of increased. There's maybe more for you to think about and worry about. Right now, what is kind of keeping you awake at night from kind of the bad end of the spectrum, but also from the good end of the spectrum? Are there kind of opportunities with AI or technology to maybe service clients? Are there things that you're excited about? But right now, as we kind of near the end of this, would love to get your thoughts on what you're thrilled about and what maybe not so thrilled about.
Mm-hmm. Yeah, we are very big on what we call the thematic investing. So certainly the theme of AI, mostly in public equities, private equity, venture, AI is a key theme for us. Another theme that we have garnered a lot of interest is really healthcare and longevity, healthcare tech, healthcare innovation, also both through public and private markets. Defense tech is another thing that's been, getting a lot of attention. It hasn't been talked about yet, but it should be. Defense tech in the venture capital space, very interesting technology out there when you think about using AI and flying, F-16 without human, right? Less on the ground warfare. Not to say, these are weapons of mass destruction, but really having the deterrence out there, that's important. In terms of what keeps me up at night, because our portfolios, our multi-asset portfolios, currently they are very defensively positioned, especially with regards to US equity. So if the S&P is come back up, in a rapidly rising environment for the second half, then we may underperform. But I just think given the policy uncertainties out there and the economic ramifications, it's not the environment we foresee for the second half of the year.
I would concur with Jasmine on the concerning side. Our clients are informed citizens. They're disconcerted by the policy pronouncements and retracements and the backdrop of instability that we're living through. We've had more questions in the past handful of weeks about what an underlying client's currency diversification is than we've ever had, in the history of Summit Rock. It has led to a broader mantra that it is a very good time to be diversified right now, and we're grateful that diversification is working. In terms of what we're excited about, is probably not that different than what you're seeing. In the venture space, there's a little bit of a venture revolution going on now, where there's a generational shift with a lot of these managers, and managers are spinning out to form their own firms. So this is exciting for us, especially if we are following, underlying venture capitalists that we have confidence in. We did build what we call like a life cycle of an investment manager, so we're not going to get in on the ground floor in Fund 1, but we're going to form like very good relationships and look to be like an anchor tenant in a Fund 2 situation, and we've done that recently, and there is this sort of generational shift occurring in the venture space that could relate to cyber, could relate to defense technology, could relate to life sciences, and also to where some of our federal research funding is receding, long-term deep scientific research that could then have longer-term commercial impacts. This is an area that you can invest with long-term capital, and where we're finding interesting things to do.
Great.
Yeah, on the generational point you made, are you dealing with generational issues even at your own clients with the younger folks at the family offices or the high net worths inquiring more and bringing, teaching you guys about things that have been helpful to other investors or other clients?
With 50 clients, we get to know the entire client ecosystem, the parents, the children, the brothers, the sisters, and our organization is 18 years old. In the past 3 or 4 years, we have seen a family matriarch or a family patriarch decease, and then you watch all the activity that goes into motion when this sad event occurs. You understand why it is that we're here and how we do need to form relationships with the next generation who will be their own decision makers at the right time. So that's a big part of our work and what we do. And they want to interact differently. They're used to meeting in Zoom. They want to have the materials like electronically and on the website. They're very different than like the in-person generation, but it's positive for our business, and it reminds us like we need to know everyone in the family ecosystem with the long-term time horizon in mind.
Yeah, for us, we certainly see the younger generation asking more about Bitcoins, cryptocurrencies, venture capital. And the way for us to deal with it, we actually run 3 sets of portfolios. So we have one set that's only traditional portfolio, so allocating to long-only equities and fixed income, globally diversified. And then the second set of portfolio is what we call the diversified portfolio. We have equities, fixed income, and alts. But the alts implementation there is all liquid alts via the 40 Act format. And then with some of the younger generation, some of the younger clients, we have what we call the fully diversified portfolios. These will go into the less liquid, truly private parts of the markets.
Yeah. No, it's interesting because even where I sit, I think people around my age and older don't really, at Thanksgiving and you talk about what you do and private equity and hedge, they don't, but like the 20-year-olds and 18-year-olds understand it and are way more educated and more involved in these types of discussions than their parents are.
They often have friends who are here at this conference today.
Yeah.
And work at they're much more conversant in the investment trends, the managers themselves, and providing that transparency as to like what's under the hood and why the portfolio for the family is constructed in the way that it is. This definitely much more informed next generation.
So as we kind of wrap up here with our last 2 minutes, any final thoughts to the group on what you expect 2025, 2026 to be for you and your clients?
Yeah, for the short term, we actually just put out our mid-year outlook, both in the written format, and we also hosted the client webinar of last week, mid-year 2025 economic and market outlook. I would say for the remainder of 2025, we're pretty defensively positioned across our asset classes. Going into Liberation Day, we were thinking about some cross-asset class trades to be defensive, like, for example, reducing equity, allocating a bit more to alternative investments, to fixed income. We have our trades lined up, but obviously, before we executed, President Trump announced the 90-day 90-day pause and the 90-day truce with everybody. But we foresee, continue ongoing ambiguities given the one big beautiful bill, right, that was passed in the House, but is expected to be modified by the Senate. We're seeing the dollar decline, down 9% year to date, likely to be the trend for the remainder of the year. So we're pretty defensively positioned for the remainder of 2025. We shifted money overseas to Europe in particular, not just within equities. We're also looking for ways to do it in other asset classes as well. I would say the view on maybe 2026 and 7, probably we're neutral. And then long term, I don't think anybody should be betting against this country. Long term, I remain pretty bullish because if you look around, you know, this country has a self-correcting mechanism, right? If it doesn't work, even the president has to reverse the course. And this is the center of innovation and growth. If you want innovations, you want growth, this is how you get it. And plus, this is the most liquid markets in the world. So long term, nobody should bet against the US.
Great. Well, thank you so much.
Thank you, Dennis.
Yeah, thank you, everyone. Enjoy the rest
Enjoy
of
the
the
rest
day
of the
sessions.
conference.